In 1700, India accounted for approximately 24% of the entire world economy. It was the largest producer of textiles on Earth. Its merchants traded across the Indian Ocean, the Persian Gulf, and into Southeast Asia. Its cities, Surat, Murshidabad, Dhaka, were among the wealthiest urban centers in the world, with populations and commercial volumes that dwarfed most contemporary European capitals. By 1947, when British rule formally ended, India's share of world GDP had fallen to under 4%. Its textile industry, which had once supplied markets from Arabia to Europe with cotton cloth of such quality that British manufacturers could not compete with it, had been reduced to a supplier of raw cotton for the mills of Lancashire. The famines of the colonial period had killed tens of millions. The per capita income of the average Indian at the moment of independence was lower than it had been at the moment the East India Company established its first trading post. The conventional framing of this transformation is military and political. The story of conquest, of armies, of the imposition of colonial administration. That framing is accurate as far as it goes, but it misses the more important story and the more instructive one. What happened to India between 1700 and 1947 was not primarily a military event. It was an accounting event. It was the systematic, institutionalized, legally structured transfer of wealth from one economy to another, executed not through simple plunder, but through the infinitely more durable mechanisms of taxation, trade law, currency control, and financial architecture, specifically designed to ensure that value flowed in one direction and did not return. This is not a story about nationalism or grievance. It is a story about how extraction systems work, about the ledgers, the taxes, the trade laws, and the financial structures that can drain a civilization's wealth across 2 centuries without a single act of visible theft. Understanding that story is relevant not because of what it says about Britain and India specifically, but because the mechanisms it describes did not disappear in 1947. They evolved, and their descendants are operating in the global financial system today. Welcome to the Hidden Ledger, where we open the books that were never meant to be public. If you want to understand the real mechanics of how wealth moves, and how it has always moved through systems designed to look neutral while producing very uneven outcomes, subscribe now and turn on notifications. Every video we publish is another page of the ledger, the hidden one. The pivot point that transforms this from a trade history into an extraction history is the Battle of Plassey in June of 1757. It is not a famous battle by the standards of military history. It was brief, its outcome was largely predetermined by bribery rather than combat, and the forces involved were relatively small. But its financial consequences were among the most significant of any engagement in modern history. Before Plassey, the East India Company was a trading entity, a joint stock corporation with shareholders in London, a royal charter granting it monopoly trading rights in Asia, and a network of trading posts on the Indian coast. It bought Indian goods with silver and sold them in European markets for a profit. This is commerce. The wealth that left India left as goods that had been purchased, and the silver that arrived in payment was a genuine transfer of value in the opposite direction. The transaction was exploitative in the sense that any monopoly trade relationship is exploitative, but it was not extraction in the technical sense. Something of value was being exchanged in both directions. Plassey changed the structure of the relationship. The company's victory, purchased with the treachery of the Nawab of Bengal's own commander, gave it effective political control over Bengal, the wealthiest province in India, and one of the most productive agricultural and manufacturing regions in the world. And with political control came something qualitatively different from commercial profit, the power to tax. What the East India Company became after 1757 is one of the most remarkable institutional innovations in the history of capitalism. A private joint stock company with shareholders seeking returns, a board of directors in London, a dividend to pay, and an army, a judiciary, and the power to levy taxes on a population of tens of millions. Corporate colonialism. The government of India was, for the better part of a century, a private business with a legal obligation to generate returns for its shareholders. The extraction that followed was not incidental to that structure. It was the point of it. The mechanism that made the extraction work was deceptively simple. The company collected taxes from Indian peasants and merchants, denominated in rupees. It then used those rupee revenues not to pay for imports from Britain, but to purchase Indian goods, textiles, spices, indigo, opium, for export to Britain and to Asian markets. From the company's perspective, these goods were purchased with Indian tax revenues. From India's perspective, its own tax money was being used to buy its own goods, which were then shipped abroad without any reciprocal inflow of silver or British goods. The trade surplus that India had run with the world for centuries, the surplus that had historically produced inflows of silver, was being captured by the company and redirected to London shareholders. The export revenues that should have returned to India as purchasing power were instead appearing as profits on the company's books. This is the drain that Dadabhai Naoroji documented in his 1901 work, Poverty and Un-British Rule in India, the first systematic attempt to quantify what he called the bleeding of India. Naoroji was not making a political argument in the first instance. He was doing accounting. He was showing, using the trade statistics and revenue figures that the British government itself published, that India was running a structural export surplus with Britain that produced no reciprocal inflow of value, that goods were leaving and nothing of equivalent value was returning. The blood was the surplus. The drain was the mechanism. And the ledger was public, if anyone in London chose to read it. The most elegant of the extraction mechanisms, elegant in the sense of being simultaneously invisible and comprehensive, was the system known as home charges. Home charges were the annual payment that the government of India was required to make to the British government and to British institutions for the costs of administering the colony. The list of items covered by home charges is worth examining in detail because it reads less like a government budget and more like a bill for one's own imprisonment. India paid the salaries of British civil servants posted to India. It paid their pensions when they retired to Britain. It paid for the construction and maintenance of the offices, residences, and infrastructure they used while in India. It paid for the wars the British fought in Asia using Indian troops, including wars in Afghanistan, Burma, and China that had no benefit to India whatsoever, and were conducted entirely in the interests of British imperial expansion. It paid the interest on the debt that the British government had incurred when it purchased the East India Company from its shareholders in 1858. India was, in other words, paying for its own colonization, including the cost of the transaction through which sovereignty over it had changed hands. The railway system that is frequently cited as a benefit of British rule in India illustrates the same logic applied to infrastructure investment. British investors who financed Indian railway construction were guaranteed a 5% annual return on their capital, underwritten by Indian taxpayers, regardless of whether the railway generated sufficient revenue to justify that return. If the railway was profitable, the investors received 5%. If it was unprofitable, the Indian government made up the difference from tax revenues. The downside risk of the investment was entirely borne by Indian taxpayers. The upside was entirely captured by British investors. The railways were also routed primarily to connect agricultural and raw material producing regions to ports, designed to move cotton, jute, and grain from the interior to the coast for export to British factories, not to facilitate the kind of integrated internal trade network that would have supported Indian industrial development. The infrastructure was real, its purpose was extraction. The process that economists call deindustrialization, the destruction of a pre-existing industrial base, happened to India with a thoroughness and a speed that has few parallels in economic history. In 1700, India was the world's largest producer of cotton textiles. The muslin of Dhaka, the calico of Calicut, the chintz of the Coromandel coast, these were traded globally and were competitive with anything European manufacturers could produce at the time. When the East India Company first arrived in India, it was buying these textiles and selling them in European markets because they were superior in quality and lower in cost than European alternatives. The destruction of this industry was not an accident of market forces. It was a deliberate policy outcome produced by a specific trade law architecture. British-made textiles entering India were subject to low or zero tariffs, while Indian textiles attempting to enter the British market faced tariffs of up to 80%. The textile manufacturers of Bengal and the Deccan were not competing on an uneven playing field. They were competing against a trade law system specifically designed to ensure they could not compete at all. The Indian weaver who had supplied the world for centuries found his market for finished goods legislated away, and was reduced to selling raw cotton to the Lancashire mills that processed it into cloth that was then sold back to India, at a margin that accrued entirely to the British manufacturer. The human consequence of this extraction system manifested most brutally in the famines that recurred across India throughout the colonial period. The Bengal famine of 1770 killed an estimated 10 million people, approximately one-third of Bengal's population, in a region that was simultaneously being taxed at levels the company had actually increased after its conquest of the province. Grain was available in Bengal during the famine. It was simply being exported, purchased, with tax revenues extracted from the same population that was starving, because the company's revenue obligations to its London shareholders did not pause for demographic catastrophe. The late 19th century famines that killed between 12 and 29 million people, the range of estimates reflecting the inadequacy of record-keeping rather than genuine uncertainty about the scale of the catastrophe, occurred during a period when India was running its largest ever export surpluses. Food was leaving the country. People were dying. The exports continued because the financial architecture of the colonial system was designed to produce export surpluses, and the administrative machinery that operated it had no mechanism for subordinating that objective to the survival of the population generating it. In 2018, the economist Utsa Patnaik published a calculation of the total value transferred from India to Britain between 1765 and 1938, using the trade data and revenue figures from the colonial record. Her estimate, approximately $45 trillion in today's money. This figure has been contested, as such figures inevitably are, on methodological grounds. The precise number is less important than the method it represents. The attempt to convert the qualitative description of extraction into a quantitative one, to move the conversation from the language of injustice to the language of accounting. Naoroji attempted the same exercise in 1901 with the data available to him. What both calculations demonstrate, regardless of the specific figure, is that the colonial relationship between Britain and India was not a relationship of mutual benefit with some imbalances. It was a net transfer of value of historically extraordinary magnitude, sustained over nearly 2 centuries by legal and financial structures specifically designed to produce and maintain that transfer. The $45 trillion figure also provides a useful frame for understanding the question of what India's economic position might have looked like without the colonial extraction. 24% of world GDP in 1700, the share India held before the systematic drain began, corresponds to an economy roughly the size of the United States and the European Union combined at current proportions. The gap between that counterfactual and the 4% that India held at independence is not entirely attributable to colonialism, but the direction and the mechanism of the divergence are not ambiguous. India did not fall behind the West because of internal failures of culture, governance, or economic organization. It fell behind because its surplus was being systematically redirected to fund the industrial development of a country that was simultaneously legislating its industrial base out of existence. The extraction routes that the East India Company pioneered did not close in 1947. They evolved. The specific institutional forms changed. The joint stock company with an army was replaced by international financial institutions, trade agreements, and debt structures. But the underlying mechanism, the transfer of value from the periphery to the center through financial and legal architecture that looks neutral on the surface, remained intact. The structural adjustment programs imposed by the International Monetary Fund and the World Bank on developing economies from the 1980s onward required, as conditions of financial assistance, the opening of domestic markets to foreign competition, the reduction of tariffs that protected nascent domestic industries, and the privatization of state assets. Conditions that bore a structural resemblance to the trade law architecture that had deindustrialized India in the 19th century. The debt service obligations that absorbed a significant fraction of the government revenues of heavily indebted developing countries, payments made to international creditors from tax revenues raised from domestic populations, had a structural resemblance to the home charges that had required India to fund its own colonization. The resemblance is not a conspiracy. It is a structural logic, the logic of a financial system in which capital flows toward returns, and in which the legal and institutional architecture that governs those flows is designed by and for the entities with the most capital. The East India Company's shareholders needed a return. The company's administrators designed a system that produced one. The modern creditors of developing economies need debt service. The international financial architecture produces it. The populations that bear the cost in both cases are not the populations that design the system or benefit from its outcomes. Understanding this continuity is not an argument for despair. It is the prerequisite for seeing the global financial system clearly enough to engage with it on terms other than those it sets for itself. India's share of world GDP has been rising for 3 decades. Its domestic industrial base, protected in the post-independence period by the kind of tariff architecture that Britain legislated against in the 19th century, has produced a technology and pharmaceutical sector capable of competing globally. The extraction routes are not closed, but they are not destiny either. The lesson of the colonial ledger is not that some economies are condemned to be drained. It is that the architecture of financial systems is a political choice. And political choices can be made differently. The story of how Britain drained India's wealth is not, in the end, a story about Britain or about India. It is a story about systems, about how legal structures, trade laws, financial instruments, and accounting conventions can be assembled into a machine that transfers value across generations and across oceans without any single act of visible violence being necessary to maintain it. The drain worked because it was institutionalized. It worked because it looked, on the surface, like administration. It worked because the ledgers in which it was recorded were written in the language of the people doing the extracting, and read primarily by the people benefiting from it. Naoroji read those ledgers in 1901 and found in them a different story than the one being told in the Houses of Parliament. Patnaik read them again a century later and found that the numbers had grown larger, not smaller, with more careful accounting. The ledger was always open. The question has always been who was reading it and what they were willing to see. If this gave you a new perspective on empire, on the financial architecture of extraction, and on the systems that shape the movement of wealth in the world today, hit subscribe. History has the answers. I'll show you where to look.